Good evening, everyone. I hope everybody is good today. So last time we stopped on Monday on hedge fund strategies. Like there were 4 main classification strategies in the hedge fund. So let's go and discuss these hedge fund strategies. But let me share the screen with you first of all. Okay. So hedge fund strategies, actually their main 4 and very popular 4 strategies that have been discussed and used in the financial markets by the hedge funds, the event-driven strategies, relative value strategies, and macro strategies, and equity fund strategies. We're gonna start with event-driven strategies. So event-driven strategies has got 4 parts, like merger arbitrage, distress restructuring, activist shareholder, and special situation. So merger arbitrage is when the hedge fund decide to just acquire a certain company or sell a certain company through the buying and selling shares of that firm. It's just acquisition. Second strategy, which is distress and restructuring, which is the purpose of the hedge fund. They buy undervalued firms which are distressed, but they're distressed financially, but for a short time period of time, okay? But with the hope they will be recovered. So they buy at the time when they're distressed and they're undervalued. So when they're undervalued, they purchase and hope that they will increase in the value again back. But it's not guaranteed, but still they make some prediction, they make some forecast on that, and they buy it. Activist shareholders, it's another part of the event-driven strategies where they buy sufficient shares of the firm in order to affect the policies of that firm with the goal to increase the value of that share actually. And the last part of this event-driven strategies is special situation where they invest in securities of the firm that are issuing or repurchasing securities. This is all about the event-driven strategy. But when it comes to the relative value strategies, it has got 5 parts, which is given here, as you can see: convertible arbitrage fixed income, asset-backed fixed income, general fixed income, and volatility and multi-strategy. So when we talk about the convertible arbitrage fixed income, it exploits the pricing discrepancies between the convertible bonds and the common stock of the issuing companies. And from that discrepancies, they make actually some markups actually. Asset-backed fixed income are the very popular income which are backed by assets, and they were very popular during before the global financial crisis. So they exploit the price discrepancy among the various MBS or asset-backed securities. General fixed income, they exploit the price discrepancy between the fixed income and securities of various types. So they're trying to find a discrepancy and they make some markup from that. When it comes to volatility, they exploit the price discrepancy arising from the difference between returns volatility implied by options price and managers' expectation of that future volatility. And the last part of this relative value strategies is multi-strategy. Exploit the pricing discrepancies among the securities and assets and classes and different from those previously listed across the asset class markets. So we're going to be a bit bored about the strategy that have been used, but when we get into the calculation, it's a bit change your mood. Don't worry about it. A little bit left time to get into the calculation, like the hedge funds calculation, incentive and the management funds fees calculation. The second strategy, which is macro strategy, they're based on the global economic trends and events that involves in long and short positions, equities and fixed income and currencies and commodities. They deal in basically with the macro trends and events. The third strategy, which is used by equity hedge funds, has got some part of it, like there are 5 divisions: market neutral, fundamental growth, and fundamental value, and quantitative directional and the short bias. So market neutral is they use technical analysis to select undervalued, and sometimes they use the fundamental analysis to select the undervalued equities to be held long, and to select some overvalued equities to be sold short. So from these discrepancies, they make money actually. Fundamental growth, they use fundamental analysis to find high growth companies, identify and buy equities of those companies that they have selected, and they're expected to sustain relatively high rates of capital appreciation. Fundamental value, they buy equity shares that are believed to be undervalued based on the fundamental analysis. And it is a hedge fund structure rather than the type of asset purchase actually. So when it comes to the quantitative directional, they buy equity securities believed that to be undervalued, and the short securities believed to be overvalued based technical analysis. And short bias, they employ predominantly short positions in overvalued equities and possibly with a small long position, but with a negative market exposure overall actually. So one thing that you need to make in here as a common and general information, that the hedge funds, the information they've got before applying any of the strategies is not transparent as in mutual funds. So that's why they are making a huge money on it. They know when the company is facing the financial distress. We know that when the company's equity shares are undervalued or overvalued. So this all information are held in the hedge fund, and it is not provided to anyone. It's not disclosed or published any of the website of the hedge funds. So it's a private. Hedge fund due diligence is the selecting hedge funds requires actually a very important investigation of the available funds. This may be somewhat hampered by lack of the transparency that we have mentioned already. And they consider their strategies and the system to be priority information. So they do not share any of the information because all the information they've got, it's prioritized. So the fact that the regulatory requirements for hedge funds discloses are minimal present additional challenges, and partial list of factors to consider when selecting hedge fund or fellow funds include some examination of the funds. So these are the factors that you should consider when you select the hedge fund, like investment strategy they use, investment process, the source of competitive advantages, historical returns, valuation returns on the calculation methods, longevity among the asset under management, management style they use, the key person risk, reputation, growth plans, system for risk management, and appropriateness of the benchmark, and so on. So these are the factors that you should take into consideration if you're selecting a certain hedge fund. So when it comes to the private equity, the majority of the private equity funds invest either in private companies or public companies that they intend to take it private. So leverage buyouts like bank debts, they use the bank debt to buy those publicly traded companies and convert them into private with a high yield bonds, and mezzanine financing. So we're going to talk about the leverage buyouts, like especially about the mezzanine. So management buyouts and the versus management buy-ins. And everybody's familiar in the private equity when there's acquisition take the place. Actually, there's a separate chapter. Venture capital is the high risk and the high returns, like it's acquisition of the new company. So venture capital with the different stages has got like 4 stages in here, basically 3 main stages, and the 4th is given as well. It's popular as well in the financial market. Starting with the first formative stage is has been divided into 3 groups, like angel investing stage, seed stage, and early stage. When it comes to the angel investing stage, it refers to the investment which is made very early at the firm's life, And it is often, we refer to the idea stage. When the idea comes to establish a certain firm, the investment funds are used for business plans, for assessing certain market potential. So basically there is no company yet, but there is idea to establishing it or acquiring it. When it comes to the seed stage, it is refers to the investment that are made for products and development. So idea already approved, and the financing is already approved. Now is time to work on the product that you're going to develop, the product that you're going to offer, and the marketing and the market research that you're making. And the third, early stage, refers to the investment made to fund initial commercial production and or sales. So it's a financing stage. It's a financing stage in the formative stage. And later stage, it is the investment that refers to the stage of development where the company already has production and sales in operating commercial entity. So when you want to acquire a certain company, so there are different stages they do take into consideration. And mezzanine stage financing refers to the capital provided to prepare a firm for an IPO. The term refers actually to the timing of the financing rather than just the type of financing. It shows that how long it takes from preparing the firm to go for IPO, okay? Committed capital is drawn down over the 3-5 years, and fees actually taken by private equities 1 to 3 of the committed capital, like used capital. In other words, so the private equity exit strategies like trade sale, IPO. So wherever the private company goes for IPO, it is exit strategy. Whenever the private company goes as recap, using recap, it shows the toward, so there is a toward to exit. If there's a secondary sale, it shows the toward exit, and there's some write-off or liquidations of the private equity, it shows the like exit strategies. Real estate. Investment in real estate can provide income in the form of rents, as well as the potential for capital gains, like appreciation in price. If you buy certain flats in a certain property, and you expect that the price will be appreciated. Real estate provides the diversification benefit to investor portfolio as a potential inflation hedge, because rents and the real estate values tends to increase with the inflation as it believed. So as there is inflation or depreciation in the national currency, the rents and the capital gains will go together with inflation or with the depreciation of the currency, of the national currency. Okay, there's a question from Begzan, sorry, that investing in real estate is said to be unprofitable in future as less offices will be used. Do you agree with that? Actually, it depends on which region are you talking about. Are you due to the pandemic? Do you mean actually in over the world we can see that honestly speaking, if you take into consideration, it depends on which country we are talking. Like World Health Organization, they said no matter nowadays, if it was like during 3 months that happened very critical pandemic, yes, during the 3 months there was really restriction on the attending the workplace and so on. That will make support to your argument actually, Bekjan. However, as from the last statement from the World Health Organization that stated that companies, or the countries, sorry, I'm saying the companies, the countries should not go quarantine anymore because it affects the economy. The US will not go for quarantine. If it goes, maybe it goes for 10%, but still they will use it. For example, in Cyprus, they already made it hybrid education, like you can attend, you can do the online as you wish. In Turkey, they are doing the same thing, so they will not go for quarantine. So no matter what happens, because if you destroy the economy, the consequences will be worse than the consequences may come after the pandemic itself. So it depends on which country we're talking. If the country that goes for quarantine, yes, it is accepted. But most of the countries, they will not go, because the World Health Organization stated that it's better not to lock down the economy, because as they saw that even lockdowns, the economies, the world stopped flying. All the flights stopped down. They locked down all the countries. No movement, even though they couldn't prevent the infection to proceed. The infection was around it and spread it. That's it. And it didn't help. So locking down the economy doesn't help the work. So the best thing is just to keep all the requirements not to be infected, like wearing the mask and so on, and keeping the distance and using some disinfections and so on. That will help you to kind of not to be infected from the pandemic and so on. But concerning the real estate nowadays, for example, what I noticed in Turkey, my brother now is living in Turkey. He bought the car. Not only the real estate, but the car, but for example, the flat. The flat price was just 2 months ago. The price of the flat was $100,000. The same flat after 2 months become 150,000 bucks. 50,000 by almost 50% jump. The same thing happened in the car industry. Second-hand cars really jumped dramatically up. It's something unbelievable, because there is a huge demand. In Turkey, in Cyprus, and other countries, so the people are started to buy and more. Even in here, the people after the pandemic, once the lockdown are out of, the people, they started to consume, buying the flats, investing the money, because buying the cars. Why do you think that people, they don't want to hold the money? They just invest in real estate, they invest in cars. I see the family, even they don't need the car, they buy the car in here in Almaty. But they
Professor,
don't. Yes.
I think this is because the Turkish lira has depreciated very much. So that's why they try to invest into commodities to somehow save some money.
Bekjan, the Turkish lira depreciated a long time ago, actually, before even quarantine took the place, before the pandemic. Yes, that contributed as well to the change in the price. But right after the pandemic, right after the lockdown was off, the prices jumped dramatically. You cannot even imagine. I was really shocked. How come? The car and so on. For example, my brother, he bought the car for 75,000 Turkish lira. He bought the car for 75,000 Turkish lira in Turkey. And after he sold it for 80,000. He sold it for 80,000 after 1 month. It's during the pandemic. Then 1 month later, the same car becomes 170,000. It's something unimaginable. Like that much dramatic increase in the price of the cars is something unexplainable. So it cannot be said that due to the. So the car model was the Kia Sportage, okay, Kia Sportage, and it's a second-hand car. And the same thing happened for all cars, but it's something unexplained. The people, they started to consume more than before. You know, the economists, they said, we are afraid that the people, before the pandemic, before this coronavirus in 2019, beginning of the 2019, the economists and the financial analysis, they were saying they were afraid that economies will go to recession, because the consumption falls like month by month. So they don't know how to motivate the people to purchase. They don't know how to make the people to buy at the beginning of the year. But now something went crazy. People are buying, and maybe they were like locked down for months, and they felt motivated to spend all the money they have, it even to borrow, to go more for credit. I'm not talking about everybody, but in general, this is the picture of the consumption that goes in Turkey, in Kazakhstan, same. For example, from my point of view, why the people, they don't want to keep the money in hand, as the Bekjan noticed and mentioned about the depreciation, the people are afraid of the depreciation. If something goes bankrupt, if the country is defaulted or something goes very bad in the country, the money will be depreciated dramatically. Like the money will lose its value, maybe by 1,000% or 3,000% or something that will be worthless. So the people, they started to use this money to invest, to buy something that you can tangible. So they trying to invest in tangible thing. And now not only the tangible thing, in the financial market as well. There are some people, they started to invest in financial paper, like buying some stocks and shares. Now I've got friends, they said we're gonna buy some flats here, and so we don't want to keep the money in hand. So this is what I believe, that they're afraid of hyperinflation in the country. Not in the Kazakhstan, in all of the countries actually.
But what I meant is that the demand for office space is decreasing because more
You
people.
mean the renting, yeah? Rent office.
Because yes, because the pandemic showed that more people realize they can work with the same efficiency from home, and after the pandemic, this habit can remain, and therefore some economists say that the real estate will be very unprofitable in future. But this
Yeah, the real actually, if you talk about that's very true. That's very true. In some cases, I agree with you in here that during the pandemic that made it. However, what I'm saying, the people are in. Well, we're talking about the. We need to be more specific in here, Bekjan. I mean, the types of the real estate is the forms of the real estate or types of the real estate, which is the next slide. What do you say? It's a. Oh, sorry. We have residential property and commercial real estate property. So the real estate part will be deteriorated. I agree somehow due to the. It's not due to the pandemic, but due to the advancement in technology. Like why we should spend a lot of the money, why we should spend a lot of money on keeping office and this water bills, electricity bills, and paying rent for it, if we can do everything online. Okay. Honestly speaking, the pandemic showed the way to save the money. So the commercial real estate properties will be actually affected negatively. However, the residential properties, vice versa. Residential properties, vice versa. The people who will stay at home, they will say, why I should pay for rent in the renting the office? I could just buy my flat in installments, just paying the installment. Okay, because as I know here that in Kazakhstan, like on average, especially around the Kimep University, the people, they rent the flats for 1,000 bucks per month. They can buy easily a flat paying in installment the same amount. So residential, the real estate will be deteriorated, but specifically the commercial part, not the residential part. You know the differences between the commercial and the residential. Residential where you live it, and commercial where you make some money from, like by renting it. So in some part, I'm agree with you. I'm very agree with you, because there will be no need to get. For example, my cousin, he recently opened an online shop. I asked him, why you don't open the normal shop that and just support by online? He said there is no need. Why I should pay for rent? Why I should pay for electricity? Why should I pay something? Because everybody is sitting in Instagram, everybody is online. I can deliver the product to any place in Kazakhstan within a day. So why should I keep everything? So I should hire somebody to sit and sell so on. So it's kind of support to your saying that nobody will want, nobody will be willing to rent actually the properties, commercial properties more specifically. Real estate investment trust, they issue the shares that trade publicly like shares of the stock. So rates are often identified by the type of real estate assets. They hold it like mortgages, hotel properties, malls, office buildings, and other commercial properties. Income is used to pay dividends actually. Typically 90% of the income must be distributed to shareholders to avoid some taxes on this income, and rate before the distribution to the shareholders. Other real estates, two additional assets that considered as a real estate are timberland and farmland, for which one component of return comes from sales of timber and agriculture products. Everybody knows where is the timberland, yeah?
Yes.
Okay. Timberland returns also include the price changes on timberland, which depend on expectation of lumber prices in the future and how much timber has been harvested actually. And farmland returns are based on the land price changes and the farm commodity prices and quantity and the quality of the crops produced actually. Another type of alternative investment we told already, commodities. Commodities themselves are physical, like gold, thus incur the cost for storages and transportation. So the returns are based on the price changes, not on the income streams actually. So the most commonly used instrument to gain some exposure to a commodity price are derivatives like future forward options, swaps, and are available in the form of commodity derivatives. So we're gonna have some specific chapters dedicated to this future and forward options. How can we use them to manage the risk actually against some unexpected situation that can face the company, specifically the financial institution. Potential benefits and risk of the commodities. Returns on commodities over time have been lower than returns on the global stock and bonds. Sharp ratio for commodities as an asset class have been low due to these low returns and high volatility of the commodities prices. Historically, correlation of commodity returns with the global equity and the global bonds have been very low, typically less than 20%. So adding commodities to the traditional portfolio can provide a very well diversified portfolio actually, and you will get the most benefit from diversification. And because the commodity price tends to move with the inflation rates, so they're kind of hedged against any changes in the price in economy. So hedge against the inflation risk. Infrastructure investment, they include transportation assets such as roads, airports, railways, and as well as utility assets such as gas distribution, electric generation, distribution facilities, and waste disposal and treatment facilities. Other categories of the infrastructure investment are communications, like broadcast assets, cable system, and social infrastructure like prison, schools, and healthcare facilities. So investment in infrastructure assets that are already constructed are called as brownfield investment. In general, investing in brownfield investment provides a stable cash flow and relatively high yields, but offers little potential for growth. So same thing I can give you when we come to the real estate construction. Just before the construction, the price is undervalued for certain property, but when it's been constructed, the price is appreciated. But when it's already constructed, the price is appreciated even more. But when it's already done, that will not grow anymore that much as it grows for construction field. And investment in infrastructure assets that are to be constructed, like they are called greenfield investment. So investing in greenfield investment is subject to more uncertainty and may provide relatively lower yields, but offers a greater growth potential. This is what we have already mentioned by giving the example of the property. So various types of tangible collectibles are considered investment, including our rare wines, art, rare coins, stamps, and valuable jewelry, and watches and sports memorabilia. So there is no income generation, but owners do get enjoyment from use it, and as with the collectible automobile. So coming to the hedge fund fees, the calculation of the hedge fund fees, how they earn money, it's here. So basically what they earn is the management fee from the committed capital and plus incentive fee. So we're gonna have some example how to solve it. Here we'll face some terminologies like hurdle rate or high watermark. High watermark versus hurdle rate, and an overview tells you that high watermark is the highest value that an investment fund or account has ever reached. So the maximum amount they could ever reach by certain committed capital. A hurdle rate is the minimum amount of the profit or return a hedge fund must earn before it charges an incentive fee. So it's kind of gives you a condition while estimating any fees for hedge fund, like incentive fee, while to calculate. So there is some information you should take into consideration. So I want to move to an example one here. A BGI fund is a hedge fund with a value of 100 million. At the beginning of the year, BGI fund charges a 2% of management fee based on assets under management at the beginning of the year and 20% of the incentive fee with a 5% hurdle rate and uses high watermark. By the way, there is a hard hurdle rate and there's a soft hurdle rate. So hurdle rate is the minimum rate that the hedge fund should earn, but hard and soft, that makes it different, that they must earn. There is no way to proceed there, but soft, so you can just deviate from it. And high watermark is the maximum rate they ever reach through their investment. So incentive fees are calculated on gains of net. Here's the key concept, the key. The incentives fee are calculated on gains as net of management fees and in value. So we're given 3 years. In year one, we generated 125 million, 0.75. In year two, we generated 127.40 million. In year three, generated 138.44 million. So we need to calculate total fees and investors' net return for all 3 years. Okay, I'll calculate here. So talking about the year one. So management fee is 2%, but it's 2% out of invested amount. The invested amount is 100 million. So 100 million times 2%, which is 0.02. That would give you a fee of 2 million. Gross value of the end of the year, which is given already. Gross value of the year, or of the end of the year, of the end year. Which is 127.75 million. Now the turn comes to calculate the incentive fee. Incentive fee.
Professor, it's 125. You wrote 127.
Oops, I'm very sorry. I'm very sorry. You see, sometimes I make mistakes. Thank you for correcting me. So incentive fee, 125.75. This is the money that we made it, minus the committed amount, minus 100, minus management fee, because why we should, and the incentive fee is at 20% on the gain of management fee, and minus hurdle rate, which is 5%. So 100 times 0.5, and this will give us times our incentive fee is 20%. Incentive fee is 20%, so 0.20. So incentive fee will be equal to, if you calculate this all, you should come up. Let me just get my calculator, just a second. If somebody can have calculation be quicker, just a second. So 125.75 minus 100 is 25.75 minus 2, and okay. 125.75 minus 100 minus 2, 23.75 minus, which is 18.75 times 0.20, that would give me 3.75 million. So my incentive fee is 3.75 million. Okay, I calculated management fee, I calculated incentive fee. Now I can calculate total fee, because I'm asked to calculate total fee. Total fee is equal management fee plus incentive fee. So 2 plus 3.75, which is 5.75 million. This is total fee. And ending value of the net of fees, like we need to calculate ending value, okay? But net of fees, we need to calculate ending value. Ending value of net of fees. Ending value net of fees, which is 125.75 minus total fee that is goes for hedge fund. So how much the investor will get it, okay? This is what it means, ending value net of fees, 5.75. So 120 million will go to investors. And we are asked all here as well to calculate the net return to investors as well. Okay, net return. Net return to investors. It's very simple. Who can tell them how much net return? They invested 100, they earned 120. 120 minus 100 divided by 100. It's a simple calculation. that makes equal to 0.20. So the return is 20%.
Professor, is it 120 or 102?
It's 120.
Okay, okay. So,
It's 120. It's not 1.2 because they invest. It was 125. 125 million, 0.75 minus 5.75 million will make 120. So 120.
I saw that the management fee was the number. Okay.
The management fee is 2 million. True, it's 2 million. But the whole amount was invested 100 million by investors. So investors, they earn, the return for the investor is 20%. Okay, this is year one, okay? This is year one. Now we move to year two. Same thing, we need to calculate the management fee. Management fee. In year two, we said what was the ending value of net of fees is 120. So 120. So this amount will be invested in the second year. Times 2%, which is in terms of dollars, 2.4 million. Gross value of the end year is equal to 127.40 million. We have incentive fee here as well. We need to calculate incentive fee. In the same way, incentive fee is calculated like gross value of the end year fee, which is 127.40 minus the invested amount in the second year, which is 120, and minus 2.40, the management fee, and minus the hurdle rate, the minimum rate that should be paid to the hedge fund, which is 120 times 5%. You remember hurdle rate is 5%. And this, of course, all should be multiplied by 0.20 by incentive fee percentage. And incentive fee is equal to, if you calculate this part, let me just quickly, 7.45
minus 0.2
minus
0.2.
0.2. Yes. Minus dollars. Wait, dollar sign. Sorry. 0.20 million. So minus means there's a what was the incentive fee? Incentive fee is the fee which is paid to the hedge fund from the performance. Did the hedge fund perform well here? No. That means they don't get anything. Okay. So since the result is negative, there is no incentive fee because the return did not exceed the hurdle rate. And what is the total fee? So in here, since the result is negative, there is no incentive fee. So total fee is equal to the management fee, 2.4 million. But ending value net of fee, like ending value of the second year, how much money left to the investors, what they are left with is 127.40 minus 2.40. That would give you ending value net of fees, which is 125 million. And the net return to the investor, net return who can tell me the net return? 125 minus 120 and divided by 120. So 0.07 or 4.17%. So the net return is less than 5%. So that means there is no incentive fee. And 5% was hurdle rate. And hurdle rate is the rate show that the minimum required money that should go to hedge fund. Okay. Now let's move to the year 3. In year 3, 138, okay. So management fee is the amount which will be reinvested in year 3 is 125 times 2%. So 2.5 million will go to hedge fund as management fee for just using this money. And we have gross value of end of the year, gross value of the end year, which is 138.44 million. And we have incentive fee here. Let me just copy this. So in here I have 138.44 minus 125 minus 2.5 125 and 5%, 20%, okay. And incentive fee is equal to if you just calculate you should come up with 0.94 million, and total fee will be equal to 5 plus 0.94 will give us 3.44 million. And we have ending value and net return. here. Ending value net of fees will be equal then to 138.44 minus 3.44. That would give us 135 million. And net return is equal to 135 minus 125 divided by 125. That is 8%, which is more than hurdle rate. That shows that proves, actually supports that there should be incentive fee for the hedge fund managers, because they really made successful to get that money. Do you have any questions? This is a solution for the question that we tried to solve it for 3 years. Calculation how the hedge funds they earn it, how they generate the money by using their capital budget for the investor. Okay, please take a picture. Now take a picture of this. I have got a surprise for you. Take a picture. Okay, once you took the picture, did you take the picture? I'm erasing it.
Yes.
Yes.
Okay. Here's example 2, hedge funds. It's for you. Take a picture, or it's available in the Moodle in the slides. You can download it from Moodle, or you take picture now of it. Try to start to do it now. You're given 1 hour starting from now. 7:30 it will be closed. I'm putting the activity 3, activity number 3. So please solve it and submit it in the same way that I did it. Okay, take a picture, because I will stop sharing and I will go to Moodle. I will create a link for activity 3 where you're going to submit your result. You can use the Excel, wherever you can. You can use the Word as you, whatever way you think you're more comfortable. Okay, I'm just stopping sharing. So in Moodle, you'll find the link. In the activity parts, that will be called activity number 3. Please, would it be possible for you to check it, whether it's available for you or not? The activity 3 in the activities part. Check it in the Moodle and give me feedback.
Yeah, it is available.